Welcome to Indianomics. I'm Latha Venkatesh, and my guest today is the renowned Dr. Nouriel Roubini. Dr. Roubini needs no introduction. His prescient calls about the global financial crisis of 2008 and the more recent property crash in China are just two instances that come to the mind. But in his latest book, Megathreats, he points to 10 threats starting from geopolitics and climate change and wars to soaring public and private debt and joblessness due to the rise of artificial intelligence that can lead to the world, in the very least, to a depression like in the 1930s. Well, today we have the man himself to learn from and to hear about these mega threats. Dr. Roubini, thank you very much for joining us, sir. Before we get to the book itself, let me start with what is immediately panning out in the United States. Do you think the banking collapse is over for now, or was that just a trailer and we may see more of that kind?
I don't think it's over. I think there'll be more financial institutions going to be in trouble. And recently, the problems of the banks have come from what is referred to as market or duration risk, meaning having long-term securities whose value is falling as interest rates are going higher. But we're going to go from market risk to credit risk, because now there is a beginning of a credit crunch in the banking system, especially the regional banks that lend money to households, to corporations, to businesses, to commercial real estate. And once there's going to be a recession, then there'll be more non-performing loans, more defaults by households and businesses, and therefore there'll be more stresses for parts of the U.S. banking system.
But you feel pretty sure it is going to be hard landing and recession? After all, the latest jobs data is indicating that unemployment is not high. The numbers are still not rising. So you think we may be able to escape without a recession at all?
Well, paradoxically, the fact that the labor market is still tight, the low unemployment rate, aging of population, restriction to migration, fall in labor force participation rate implies that the wage inflation is still too high, and therefore the Fed has to increase interest rates even more to achieve the 2% inflation target. But if they raise interest rates even more, there'll be two problems. One, the likelihood of a recession becomes more likely, and a severe recession. Two, they will have more financial stresses, not just for banks, but for other holders of assets, and also for those who have too much debt, going to face debt servicing difficulties. And there'll be a doom loop between the economic contraction and financial stresses. So there is a contradiction between the achievement of price stability on one side, maintaining economic growth, and having financial stability. And the recent stresses in the banks makes this trade-off even more hard to achieve.
But what if they wimp out? What if they just learn to live with a 4% inflation? Would that still mean stagflation? Or would it mean, well, some kind of growth, not very good, but, we still amble along? Is not that a possibility?
I think that the Fed, like most major central banks, will wimp out, gonna blink, because the consequences of going back to 2% inflation will be economic and financial instability. In the short run, that may prevent a recession. In the short run, the stock market may rally. But if you blink, then there'll be a de-anchoring of inflation and inflation expectation. There'll be a more severe wage price spiral, and we'll have a repeat of what happened in the 1970s, when the Fed was behind the curve, inflation got out of control, and then we still had stagflation because of negative supply shocks. And you can postpone a debt crisis maybe by a couple of years by wiping out the real value of nominal long-duration debt with unexpected inflation. But once inflation expectation moved upwards, then long rates are going to be higher, short rates are going to be higher, nominal and real are going to be higher, and therefore those who have high debt ratio are going to still face eventually insolvency. So you're going to postpone the stagflation and the debt crisis, but you're not going to be able to avoid it over time.
Okay, yes, you argue that very clearly in your latest Project Syndicate essay. and to, in the medium term, in the Megathreats book. But before I come to that, Dr. Roubini, what would you advise investors then? As you point out in your Project Syndicate article, the 60-40 debt equity didn't work at all in 2022. Investors lost on both counts. Is there a place to hide now?
There are options. Absolutely, 60-40 works only when inflation is low, and therefore the correlation between equity and bond prices is negative. But when inflation is rising even more gradually, you get that equity do poorly because the discount factor for equity, long rates is higher. But long rates being higher means the price of bonds is lower, and therefore you lose money even on, unquote, the safe defensive asset is bonds. What you need to do to protect yourself from inflation are several things. One is short-term safe bonds that reprice higher with higher yields without the price impact of long duration, inflation index bonds, gold, and other precious metal that do well when there is inflation, the basement of fiat currency, but also when there is de-dollarization in the world. And also you want to go in some of the green metals. The green transition is going to imply more demand for the green metals, but the supply is going to be limited by a variety of constraints. Finally, sustainable forms of real estate may also be part of that portfolio. You need real assets that do well when inflation is moderately high, but you need to do real estate that is going to be sustainable because many real estate assets, even in North America, are going to be stranded because of global climate change. Flood, hurricanes, sea level rises, heat waves, droughts, you name it. So you have to think about alternatives to traditional 60-40.
Oh, yes. I think people are already listening to that advice. We are seeing the way gold has been trending higher. But Dr. Roubini, what about emerging markets as an alternative asset class? At least in India, and I'm sure in several other emerging markets as well, we are already into positive real rates. Interest rate is higher than inflation. Would that be a worthwhile asset class?
It depends. You have to distinguish between the better credits in emerging markets and those that have high inflation, twin fiscal and current account deficits, and other forms of macroeconomic problem. I would say that India, among emerging markets, is certainly a positive one. It has a high real rates, has a reasonably stable now monetary policy fighting inflation. Fiscal policy could be better, but is okay. And the structural factors for India go in the favor of India. Potential growth around 7%, maybe higher with more economic reform, a young and growing population, a catch-up of per capita income because it's much lower than China. So India is going to be a rising power in the next few years and decades with additional economic reforms. So certainly India and a few other emerging markets might be a good place to invest, both for fixed income and even in the equity markets.
Okay. Well, that's good to hear, at least the viewership here who is listening to you right now. But Dr. Roubini, you spoke about de-dollarization. That's been a real talking point, especially after the sanctions against China. You think that can work, a non-dollar medium of exchange between countries?
Well, it's clear that the strategic rivals of the United States, China, Russia, Iran, North Korea, Pakistan, and their own friends and allies, want to build an alternative economic, monetary, and global reserve currency system because they're concerned about the sanctions that the US, Europe, and others can impose. You know, the Chinese have $1 trillion of dollar reserves. And therefore, they're going to move in the direction of proposing the RMB as being an alternative to the US dollar. And gradually, of course, we're going to go from a unipolar to a bipolar global reserve currency system. In that system, however, I see India being closer to the West and to the dollar rather than being close to the RMB. You know, China and India are strategic rivals. They have border issues. It's true that India right now may need oil, energy, food, fertilizers from Russia, but that dependency can change over time. And I see the future of India geopolitically being member of the Quad, being closer to US and the West. And also, it's going to benefit from friendshoring. Money is going to be moving out of China because of the risk of China. It's going to move to places that are much more friendly to the West. One of them, given the industrial and tech base, is going to be India. So I assume that India is not going to be part of that de-dollarization process.
Oh, absolutely. I guess India would do anything to have a dollarized world rather than a yuanized world. There is no taking away from that. That's our eggs are in that basket. No taking away from that. But let me come to the book, Megathreats, and the crises that you speak over there. The first of them, actually, let me start with this bipolar or multipolar world that we are heading into. The US-USSR divide could still work and we could have a protracted Cold War because they didn't have interlinkages. A Cold War between US and China doesn't look even plausible because there are so many interlinkages. So do you think the two powers will amble on because there is so much that they are buying and selling to one another?
Well, it's different, as you point out, compared to the Soviet Union. But unfortunately, geopolitics is going to be driving economic and trading patterns. It's not as if we go from full globalization to full deglobalization. It's going to be a matter of degree. There'll be some degree of deglobalization, of fragmentation of the global economy, of decoupling, of balkanization of global supply chains. After all, we used to care about free trade, then about fair trade, now about secure trade. We used to think about offshoring, and now we're thinking about reshoring and friendshoring. We used to have a just-in-time, a global supply chain. Now we need a just-in-case, redundant, in case there are geopolitical shocks. So the trend is towards a greater restriction to the trading goods and services, in the movement of capital, labor, technology, data, and information. But that's going to be, as I said, benefiting those emerging markets that are actually friends of US, Europe, and the West. And I see India being one of the success story of this process, where you care more about friendshoring, secure trade, and just-in-case global supply chains.
Okay. Dr. Roubini, one of the most interesting theories I found both between your book and the Project Syndicate article is the fact that we are probably staring at a protracted global inflation for various reasons. I want that discussion in a minute after this very short break. Welcome back to this very special Indianomics. I've been speaking with Dr. Nouriel Roubini, and we will be speaking right now about his latest book, Megathreats, which has got rave reviews from a whole host of economists. Dr. Roubini, thank you very much for waiting on. Well, one point that you point out both in the Project Syndicate article and in the book Megathreats is the likelihood of protracted inflation, given the fact that there is friendshoring and nearshoring, as you point out, higher protectionism, as well as this chase for greenflation, as you call it. Can you tell us, is this what we are, is the period of deflation over? Is it behind us? And are we clearly leading into a medium-term inflation?
Yes, we are, both for supply-side reasons and demand-side reasons. On the supply side, there are a number of medium, long-term stagflationary shocks and trends that reduce potential growth and increase the cost of production. They are restrictions to trade, protectionism and deglobalization, reshoring and friendshoring, aging of population in many countries, restriction to migration, geopolitical depression and decoupling, global climate change, pandemics, backlash against income and wealth inequality, cyber warfare, and weaponizing the dollar. On the demand side, we live in a world where there is so much private and public debt that the central banks try to raise interest rates to fight inflation that cause an economic and financial crash. There'll be structural budget deficits. We have to spend more on security, to fight climate change, to fight the next pandemic, to fight robotic automation and the implication for jobs, and to reduce inequality. All those things imply more government spending that constrains how much we raise taxes. We'll have structural larger budget deficits that either crowd out growth or they cause a debt crisis, or if we monetize them, we can wipe out some real value of this debt and deficits through inflation. So I fear that the path of least resistance is going to be to monetize and higher average inflation. Not very high in advanced economies, but not 2%, maybe 6% or so in advanced economies.
Oh, that changes the grammar of international finance altogether if we have to have, you know, a 6% Western nation inflation. I'll come to that in a minute. But coming back to mega threats, you know, one of the big things you point out is the likelihood of war because of this alternate set of countries, Iran, North Korea, Russia and China, challenging the system put in by the Western nations. You know, we have come to the brink of war even during the Cold War. I mean, the Cuban Missile Crisis and other such flashpoints. But we moved back. Do you not think that we will move away from the brink even in the times to come?
Well, certainly we'll have cold wars that are getting colder. Whether those cold wars lead to outright hot war is to be seen, hopefully not. But even a situation of cold war is going to imply decoupling, fragmentation, balkanization, and stagflationary shock. But look, we already have a hot war because of the brutal Russian invasion of Ukraine. This year, this war could become unconventional, could involve NATO. I was recently in Israel, but it's clear that Iran is becoming a threshold nuclear state. Israel will have to think of whether to bomb Iran or not. Either way, there'll be cost. And the Cold War between US and China is becoming colder by the day. There could be a looming conflict on the issue of Taiwan. But China has also territorial disputes with half a dozen countries in Asia. There are thousands of miles of the border between China and India that are disputed. There are disputes with Japan, with Vietnam, with Indonesia, with the Philippines, and those tensions at some point could reach the boil. Now that China has stopped to hide their strength and bide their time, they're projecting power all over Asia.
Oh yes, that is several flashpoints and several of them on our border as well. Dr. Roubini, to come back to the inflation point that you're making, it's extremely convincing that we are not returning to the period of deflation. There is a medium-term inflation threat in front of us. If that is the case, then what are the changes that you see? Do you see changes to currency? Do you see a reduction of global growth itself, reduction of global trade itself because of this inflation threat?
Yes, the combination of inflation and negative supply shock implies a world where there is lower growth and higher inflation. That is bad, of course, for US and global equities, but is even worse for bonds. Last year, when US Treasury yields for 10 years went from 1% to 3.5%, you got 20% losses on bond prices, worse than the S&P that fell 15%. Suppose that the new normal is 6% inflation, then 10-year Treasury yields, they'll have to go eventually to 8%, 6% for inflation and 2% real. Now they're at 3.5%. Yes. They go from 3.5% to 8%. You have another 50% losses on what is supposed to be a safe, secure, and defensive assets, trillions of dollars of dollar treasuries or EM debt linked to the dollar or of high yield and high grade bonds. So the risk of significant losses both in bond markets and even in credit markets are significant.
Okay. Well, there should be a rush to buying commodity and commodity stocks and gold, as you point out. That seems to be the only safe harbor at this point in time. Well, Dr. Roubini, you know, of all the threats that you mentioned, which do you think is more imminent, can happen? And a related question, can science cure the problems that science has led us to? Like, you know, after all, vaccines cured the pandemic. So do you think science and sensibility can still prevail?
Well, in the short run, we have to worry about inflation,
Okay.
about recession and stagflation, about high debts and high interest rates causing a debt crisis, what I call the risk of a great stagflationary debt and financial instability. But some of the medium-term threats are becoming more proximate. The risk of war and the geopolitical depression is becoming front-loaded. The cost of global climate change, the risks that come from another global pandemics as severe, if not more severe, than COVID-19. And of course, with generative AI, the risk of displacement of many jobs, blue collar, high collar, white collar, but even creative becoming a looming thing. Yeah, technology can help us. If we have major technological revolution, AI, robotic, automation, machine learning, maybe we find a solution to climate change. Maybe we can increase the economic pie and make that more sustainable. Maybe we can find faster a cure for not only COVID, but other diseases. We may even reduce some of the geopolitical tension if there is greater economic growth. But on the other side, AI, machine learning, robotic automation leads to permanent technological unemployment, increases wealth inequality. It might even lead us to build bigger weapons to fight a bigger cyber wars. So we have to make sure that technology is used to increase the economic pie, to redistribute it to everybody, and to create peace, progress, and prosperity, as opposed to more inequality and more violent conflicts among rival powers.
Well, ultimately, good sense has to prevail, isn't it? Whether it is science or whether it is politics. Point taken, Dr. Roubini. This conversation will, I'm sure, goad more readers, more viewers to read your book and ensure that those dangers don't pan out the way you have described them. Thank you very much, Dr. Roubini, for joining us in this conversation.
Such a pleasure being with you.